Economies of scale, distribution muscle, let's do a merger. Don't like the sound of that? Well, here's another pitch. Focus on core competencies. Present a clear investment case. Let's break up the company. Hard choice? Not for Dow and DuPont. Late last year, the two chemical companies announced a combination. Both have market values of about $60 billion, designed to squeeze out $3 billion in costs. The merged company will then be split into 3 focused companies. This makes the other big transaction in the industry, China's recently announced purchase of Syngenta for $44 billion, look unambitious by comparison. But at least those two are doing something. BASF, the largest chemical group in the world, with a market value of $65 billion, has so far scandalously done no transaction whatsoever. Can this indolence stand? Last week came reports that BASF was considering a counterbid for DuPont, and perhaps it ought to do a deal with Monsanto, which, weighing in at $45 billion, is the other industry giant left out of the frenzy. But there is a better option. Do nothing. BASF stock has been beaten up, but it has a plan to cut costs, and it generates plenty of cash to support its dividend. The yield is a meaty 4%. And in a few years' time, when its competitors are still untangling the webs they've woven, BASF might be able to make smarter deals in a buyer's market, or spin off businesses when they are stronger than they are today. There is, however, a risk for BASF and its boss, Kurt Bach. Mergers look very bold, but it is very hard to measure their results. They are uncontrolled experiments. Without a deal, the market expects measurable, steady improvement in results. Of course, many bosses choose the unaccountable option. For Mr. Bach, all the same, the motto should be, don't just do something, sit there. Rob Armstrong, Lex.